Welcome to Takeaways. My name is Jordan Brooks. I'm Senior Market Analyst with ALN Apartment Data. And in this month's edition of the Takeaways series, I wanted to talk about a couple of topics that were sort of tangentially related to the newsletter, but that I didn't really go into much detail on in the article itself. So the December newsletter, for those that haven't read it yet, was basically a rundown of apartment demand. We looked at sort of some national trends and then zoomed in on some specific markets and things like that. But one of the things that I wanted to talk about today is just sort of the shortfall of net absorption relative to new supply that we've seen over the last few years. What was really interesting about 2021 coming out of the pandemic was net absorption was over 600,000 units nationally. And even though it was a big year for new supply, that excess absorption really drove the occupancy and rent gains that we saw in that year. Basically, lease concessions disappeared from the market, and we had gap between new supply and absorption of a little over 300,000 units in terms of absorption outpacing supply. But in the years since, what we've seen is 2022 completely made up for that excess absorption that we saw in 2021. So in 2022, about 350,000 more new units were added than absorbed nationally. And so we saw that just huge swing from one year to the next where, we had a lot of new units being built, but a lot more units being absorbed. And then immediately we came back to the inverse of that in 2022. And then in 2023, we saw a little more than 300,000 more units added than absorbed nationally. So again, that was on top of the 350,000 unit deficit from 2022. And then in 2024 so far, again, this is not with the December data in, but through November, that deficit is right at 300,000 units. So with the December numbers coming in, we'll probably be around where we were in 2023. Little over 300,000, maybe 310,000 more units added than absorbed. So a couple of interesting points about this. For one, if you just take those 4 years together, 2021 through 2024, we're already sitting at a deficit in absorption of almost 650,000 units. So again, that speaks to the scale of the new supply that we've seen, but also the inconsistencies in apartment demand that we've seen in that period. Now, to contextualize that number a little bit, in terms of conventional nationwide units that ALN includes in our sort of market statistics, you're talking about 15 million units. So that shortfall in absorption over the last 4 years is roughly equivalent to about 4% of sort of that total conventional stock nationally. Now, some good news. We've seen new supply ramp up year over year for the last handful of years. So again, 2021 was a pretty big year for new supply, but we were at about 355,000 new units. 2024, again, with 1 month to go, we're already at about 570,000 units. So we've seen a substantial increase in new supply in recent years. But as you may remember from those numbers I was referencing, we've actually seen the deficit of absorption to new supply winnowing in recent years. And that's because we have seen a steady and fairly robust absorption rebound over the years. So, 2022 was sort of the trough year where we had less than 100,000 net units absorbed across the country. And then 2024, again, with 1 month to go, we're at about 275,000 units. So we've seen a nice uptick in demand. So that's just a sort of a piece of bigger picture context when we talk about, obviously occupancies are soft, but we see, rebounds in demand. We talk about the development cycle peaking probably in 2024, all of these things working together. As we get into 2025 and 2026, when we expect deliveries to slow a little bit, and we hope to see continued improvement in demand, we're going to have that 600,000 plus unit pool of excess supply from the last few years to start working through to get occupancies back up. And then sort of on a related note, talking about some regional differences, I wanted to just briefly talk about the interesting dichotomy right now between market metrics and how you might point out which markets are doing well versus which markets are struggling. Because of the new supply that we've seen in recent years in particular, and the tip of that spear has been the Sunbelt region. The effect that new supply has had on Sunbelt occupancy has been profound, obviously. So if you look at the top 30 markets nationally for lowest occupancy, the majority of those are going to be Sunbelt markets. Similarly, if you look at the 30 markets around the country with the lowest rent growth over the last year, the majority of those are going to be Sunbelt markets. However, if you look at market leaders in net absorption over the last year, 9 of the top 10 are Sunbelt markets. And even if you use a size adjusted metric, which we like to use at ALN, so we take absorption divided by existing stock to sort of give a size adjustment to the demand number, the majority of the market leaders, again, are in the Sunbelt region. And a good portion of those that are not Sunbelt are Mountain West markets, which has also been an area that's gotten a lot of new supply in recent years. So, again, if you're just looking at, well, tell me which markets are doing well, and you're looking at rent growth, you're going to say, wow, the Sun Belt's really struggling, and the Midwest and the Great Lakes are looking really great. But if you look at the Midwest and Great Lakes region, if you look at demand, absorption has been fine there, but not particularly robust. The story there has been less new supply, less downward pressure on occupancy, and therefore, because you have higher occupancy, you're getting better rent growth. And so, normally if we went back sort of 2017 to 2019, that time period, it was a much more homogenous picture where the Sun Belt was looking good from a demand perspective, and occupancies and rent growth were good in the Sun Belt, and you could say, wow, the Sun Belt's doing great. Now, because of the dynamics that we've seen between supply and demand in recent years, it's a little bit different, and so it's worth paying attention to, again, as we move forward, expectations for which regions are going to be doing well or struggling a little bit. What you, I think, would want to look at is, well, where has the demand consistently been good? That's still the Sun Belt. So once they get through this glut of new supply, 2025, for the most part, for a lot of those markets, will be a little bit of a downshift in supply. And then 2026, we would expect a further downshift in supply. The demand there is good. The supply picture will be improving, and so you would expect things to improve there. Whereas, again, I'll use the Midwest as an example. The rent growth that we've seen there that's been well above average has a lot to do with just less new supply and less competition for residents. So if you have a market in the Midwest where new supply is expected to increase in the coming years, then you'd want to say, okay, well, what has the demand trend been there? Because the rent that we've seen has been really not as correlated with demand as maybe you would expect. So just, kind of some tidbits there. We'll be putting out at ALN in the coming weeks quite a bit of written content on the blog about sort of upcoming expectations for 2025 and some differences between regions, market sizes, etc. So definitely check out the ALN blog. It's alndata.com/blog for all of that content and some more details along these lines. I normally plug some upcoming events. There's really nothing coming up until February, so we'll table that until next month's episode. And on your social media platform of choice, check us out, ALN Apartment Data. Search us on whatever your preferred platform is, and you will find us. See you next month.